and welcome to Indianomics. The key factor that changed the grammar of the world financial markets over the past 1 week has been the Fed statement indicating that the number of rate hikes in the coming year will be 2 rather than 4. Commodity prices, which have already been gaining ground, gained further ground this week after that Fed statement, which pushed the dollar down to a 5-month low. So is this a seminal troughing out of commodity prices, especially crude? That's the question we have to grapple with in the next few months. And I have someone who is best placed to answer that question. Seth Kleinman, the head of energy strategy at Citi Research, joins us. Good day to you, Mr. Kleinman. Well, that really is the first question. Has crude troughed out for the moment for this super cycle?
Yeah, I think it has. I mean, what we saw back very early in the year was crude oil prices being pushed down to levels that just you could see that the industry, it just couldn't take. I mean, below $30, the industry just doesn't work down there. And you saw it most dramatically in terms of the response from U.S. shale. But you're also seeing some fields getting shut in China. You've seen talk of fields getting shut in a wide variety of other countries. $30 was too low. We've rebounded to a more sustainable level. We'll see where we go from here. I don't think it is too much more upside from here, but we'll see.
Okay, that's exactly the next question, really. There has been a lot of bullishness getting built in the run-up to the Doha meeting of oil producers, especially the OPEC countries. Do you expect that supplies will be cut in the run-up to April Doha meet? Where do you see crude trending? And what are you expecting in Doha at all?
Well, the market clearly wants to believe, but I'm not really a believer at all. I think that what will happen in Doha will change basically exactly nothing in terms of actual barrels put on the water and barrels for sale. That said, clearly the market wants to believe. But the reality is when you're at $30, you could talk about some kind of joint action that would boost prices maybe by $10. And that might work. You can get up to $40. You're not necessarily going to reactivate shale. You're not going to see that's not going to increase production from elsewhere. But when you're at 40 and you talk about some kind of action that boosts you to 50, somewhere between $40 and $50, you're going to start to see the return of U.S. shale production. So their options for their room to maneuver at $40 is significantly much more constrained than it was at $30.
All right. Let's talk some ranges then. In the run-up to April, what do you expect will be the range for crude and indeed for the rest of 2016?
So I think we're in a $35 to $45 range. Above $40, you're going to see less buying from China because of the way their market is now structured. And between $40 to $50, you start to see the return of U.S. production. So I think we're capped in the low 40s. If we overshoot that, then you risk bringing on a bigger supply response, and then you get according weakness later in the year. But I think now we're really in a low 40s, high 30s range. As towards the end of this year, as long as we don't overshoot to the upside now, then I think you will start to see more widespread supply declines outside of America, and that's enough to push us closer to $50 towards the end of the year.
Okay. Do you see 2017 being bullish at all? I know it's too far out.
Yeah, I think you can see I think we will continue to grind higher into 2016, 17, and even into 18 as we start to see, there's a very long lead time. There's a long lag time in this industry. So projects that got cut or canceled or curtailed when we were down at $30, that's going to take 6-12 months to show up, but it will affect supplies. So as long as the global economy keeps trucking along and doesn't have some kind of hard landing, then I think demand will keep growing, and the tightness in supplies will increase over the next couple of years, and prices move higher as a result.
Okay. Let me veer away from crude to its allied commodity, gas. How do you see gas prices trending in the West, but more importantly in the East? One understands that Australia is on the verge of increasing its gas supplies considerably by 2017. So lay out the gas price trajectory for us.
Gas prices look like they stay under heavy pressure here. Because it's not just Australia, it's also the United States. Between the two of them, you have a two-pronged surge in supply that's coming online, just as the particularly Asian demand. Asia is always the real driver of energy and particularly gas demand growth. You've got slower economic growth in the region, and you also see this continued exponential build-out in renewables and very cheap coal. gas prices, look, they could easily trade down to $4 LNG-wise in Asia. They're already sub $5. Unless you have an incredibly hot summer or an incredibly cold winter, absent some kind of big weather extremity, there's really no way of seeing how you can mop up the oversupply of gas, which increases as Australia and the United States continue to push more gas into global markets.
Okay, so the average gas price in 2016, more importantly in 2017.
Average gas price for LNG,
yes,
somewhere around the sub $5 for here and probably closer to $4 in 2017.
Okay. One final question, not exactly your area of extraordinary interest, but commodities other than crude have also seen a bit of a leg up. The charters tell us that the copper chart has definitely troughed out. What's your sense about metals for this quarter and for this year?
Well, we were expecting a rally to come in metals because you're starting to see prices were low enough that you were starting to see supply curtailments. Meanwhile, demand actually was looking okay. We were expecting a rally later in the year. It's come a little bit earlier than we expected, but we still think that overall the demand and supply for copper remains constructive. So we think that by the end of this year, you're in deficit, and that deficit can grow in 2017. So we're optimistic in terms of prices on copper. We still think this rally has some legs, but what's tricky is trying to figure out what is copper or metal specific and what price move came about just because of a massive unwinding of the biggest consensus short in the market, which was short emerging markets, short everything China and commodity related. That trade en masse got unwound over the past 4 weeks, really. And so you've seen every commodity rally. You've seen everything from timber to coal to iron ore, some commodities that are really in severe oversupply. Fundamentals haven't changed at all. They've rallied right along with things like copper, where you could paint a more constructive picture. So the question is, has the whole market gotten ahead of itself and then sees a setback, or do we start to see some differentiation on the part of how these commodities really start trading?
Okay, that's interesting to distinguish, but perhaps what worries us more really is steel price, not exactly a commodity, but a value-added one. A lot of dumping still happens from China and the Far East into countries like India. That perhaps is another story, but do you have a view there? Do steel prices also stabilize at a slightly higher level? We saw them fall all the way to $250. Do they stabilize closer to $400 for the rest of the year?
See, steel is really the perfect example. There's really nothing fundamentally bullish that has changed in the steel story. You're still talking about a severe glut that is really difficult to manage. When you talk about overcapacity in various industries in China, with steel, it's a chronic overcapacity. There's really no sign of it getting rationed here, and yet prices have rebounded. So I think steel is one of the commodities where this rebound is looking really unsustainable.
All right. Well, that's not very pleasant for the steel producers in India, but nevertheless, pleasure speaking with you. Thank you very much, Mr. Seth Kleinman, for joining us today.
Thank you very much. Bye-bye.
Bye. Well, so the message quite clearly is that crude stays in the early 40s. So the Indian fiscal math doesn't go terribly awry. But on the other hand, the higher commodity prices doesn't mean the pressure on steel prices or lenders to steel companies in India are going to see any relief. That's the message from a global commodities expert. We take a break on that note. Hereafter, we are going to be joined after the break by Manoj Pradhan, the global economist from Morgan Stanley.